It's time for the big picture now. So let's welcome in Liz Ann Sonders, Chief Investment Strategist, Schwab Centre for Financial Research. Very good morning to you, Liz Ann. So we're kicking things off for the fresh week, the fresh month of November, on a bit of a mixed note. Typically, November is a good month for stocks. What's your outlook for this month?
Yeah, it wouldn't surprise me if we continue to see a bit of rotation under the surface. We had kind of a brief broadening out phase that helped, at least in relative terms, equal weight. It helped small caps. I think that was very much driven by the shift toward easier monetary policy. That may have come to at least a pause, if not a halt, as of last week, which I think has moved money back up the cap spectrum, and we've redeveloped kind of a concentration problem on somewhat weaker breadth. I think at least until the point where we start getting government issued data, it wouldn't surprise me if you continue to see these rotations under the surface, but still a bias toward the mega cap names.
Okay, and certainly that's what we've been watching as far as that some of the concentration risk out there. You know, as we think about sort of year-end positioning with just a couple of months to go now, there certainly seems to be a lot of question marks on the horizon. You know, first and foremost, when this government shutdown might actually end, and then, obviously then what Fed Chair Jerome Powell and co are going to do at this next meeting, and then also with regards to all the other sort of geopolitical sort of cross currents that we're dealing with. How are you and the team sort of thinking about that as far as some of that year-end positioning with a lot of these sort of moving parts in mind?
Well, I think in terms of the Fed, in our view, it's maybe slightly biased toward the Fed for now anyway, being on pause, meaning no cut in December. That was maybe one of the most interesting things that came about with last week's meeting was the double dissents, one in the direction of more aggressive policy, one in the direction of not cutting at all. And unless we either get government data coming in and it's supportive of an additional cut, i.e. weaker employment trends, then I think the bias might be toward the Fed not giving us a rate cut in December. As far as positioning is concerned, retail traders are still dominating this market. You've seen an increase in terms of what share they represent of daily trading volume, and their shift has been away from what had been a really low quality bias within this broadening out within the smaller cap trade, more than double the performance of the non-profitable segment of the Russell 2000 versus the profitable segment since the April 8th closing low. And maybe because the Fed moved away from easier policy, or at least a definitive stance toward easier policy, I think that has shifted a lot of retail trader money, not fully back into the Mag 7, but selectively back into mega cap AI related names. It's also the case that only 3 of the Mag 7 now are outperforming the S&P on a year-to-date basis. And NVIDIA, which is the best performer of the Magnificent Seven, is ranked 39th in the S&P from a price performance standpoint on a year-to-date basis. So there's just a much fuller story being told under the surface of these cap-weighted indexes, and I think that's likely to persist as we get closer to the end of the year.
Yeah, you raise an interesting point of 3 of the Mag 7 stocks are outperforming: NVIDIA, Alphabet, and also Microsoft. I heard one taker earlier this morning that those that are underperforming perhaps don't have a strong enough sort of AI narrative. I mean, we certainly know that has been some of the story with Apple, Tesla obviously in a different category in that respect, somewhat, for now at least. But I'm just wondering, if we can pick up on that, Liz Ann, with regards to sort of the tech earnings that we heard from last week, the Capex sort of indigestion that the market had, particularly off the back of what Meta said. And as we look ahead to NVIDIA, what your thoughts are around this?
Yeah, I mean, the Capex numbers in the aggregate are absolutely massive. But I think what we're starting to see more attention paid to are things like free cash flow growth, the likelihood that the financing of this major Capex boom is going to be more via the debt markets, either on the public credit side or the private credit side, versus out of cash flows. And that's in part because even if you look at the Mag 7 as a cohort, free cash flow growth has now been 2 quarters in a row in negative territory. 6 quarters ago, that free cash flow growth was more than 60%. So we've seen kind of a complete round trip in terms of that free cash flow growth. Now, you could still have a long runway in terms of additional Capex being funded by debt, but it's just a different backdrop, not to mention a few companies coming out and talking about some pressure on margins. So sort of this free for all, it's to the benefit of everybody, top line growth, bottom line growth, strong free cash flows, financed out of free cash flows, margins that are staying healthy. It's a little bit more differentiated a story right now, more fine-tooth combing of the individual companies.
Oh, absolutely. Liz Ann, always a pleasure. Thank you so much for helping us get started this week. Have a great rest of your day. Liz Ann Sonders
You
there,
too.
the Chief Investment Strategist at Schwab Centre for Financial Research.